I'm Keith McCullough. Welcome to day 2 of the Hedgeye Investing Summit. This is the 15th one that we've done, so we've been doing it for 7 going on 8 years. It is a rarity, suffice to say, that I get to have an opportunity to meet somebody like on a live wire. I just started to have a conversation with Jared Kubin. His content, as we get into that a little after, like once we get through, I want to get through your biography and your story and part of your journey here, but it is excellent. I can't wait to get into this conversation, so thanks for making the time.
Awesome, Keith. Thanks for having me.
Yeah, we're biased, so we'll take on like athletes turned hedge fund guys. You know, like we do have a lot of similarities in terms of that. Do you want to, maybe just start with that, your background, how you went from baseball to the hedge fund community?
Well, I appreciate it. If you ever need a ringer to come in for the company softball game, I'll come up from DC. So
we need one. We are terrible. We have nice jerseys, but I think we actually got DQ'd in a couple games. Like, we could use it.
It's no good. All right, I'll be the hitting coach for sure. So I appreciate you having me. Big, longtime fan of yours and Hedgeye and what you guys have done through my career. So congratulations on everything. Thanks for having me. My career, I grew up in Washington, D.C., took a baseball scholarship to the University of Florida, very, very fortunate to play there, played in the College World Series. Unfortunately, 2 reconstructive shoulder surgeries later, had to pivot my life really back to my other love, which was technology, engineering, math. A friend of mine was starting a distributed database company while I was in college, so kind of had to decide, did I want to go around the minor leagues? Did I want to rehab my shoulder? Decided to join the startup as a co-founder, built one of the first distributed instances for this database on Rackspace. If you remember, kind of pre the AWS days, Rackspace was one of the big players in it. So I really jumped headfirst back into my other love, which was technology and engineering, and graduated school, started another company in the data recovery space. I was living at home in my parents' basement. Interesting anecdote for you. I was shipping all these Dell pizza box servers into the basement. Went to my mom one day and told her, Mom, great news. We don't have to have all this big heavy equipment down here anymore. There's this company where I can rent compute from. And she's like, Jared, I don't know what company that is, but you should buy stock in it. And obviously that was AWS. And I said, Mom, you probably should have been the hedge fund manager. So 2 startups.
That's awesome.
My career kind of took me, went to Harvard Business School. They actually recruited me for the intramural softball team, which was an amazing experience for me. I fell into the hedge fund world, and that's where I started my career, working at SAC Capital.
Yeah, and you were at Balyasny, Adage, like the big spots. So you get to learn a lot. I think for me, at least, that was one of the most valuable parts of my journey, was just getting to know how it worked inside. All 3 of those places, by the way, they don't work the same inside. So however you want to talk about that, I think that'd be helpful to people.
No, it's exactly right. I mean, if you could picture it, I was probably, at my first job covering tech on a TMT team at SAC Capital. It was unbelievable. A legendary officer with some unbelievable investors. I got to go every day and hear them talk about Apple versus BlackBerry, the industry dynamics going on in smartphones. This was a rise of the SaaS business model, how they were thinking about analyzing these new types of companies and cash flow statements. So I got to really just immerse myself and become a student of investing. Steve was always unbelievably gracious with his time. When I was there, I was the youngest, probably lowest ranking analyst at SAC at the time, just dumb enough to talk to Steve. So Steve would always, anytime I had questions, he used to tell me everything about trading billions of dollars in the morning to talking about shorting stocks. So I had an unbelievable experience there. Bally was, another tremendous place. Dimitri, I think, is one of the most forefront thinkers in the multi-manager space, just an excellent founder and CEO. And then Adage. The Adage guys are legendary. The guy I worked for there was one of the best fundamental investors, gave me a real deep understanding of analyzing companies and sectors, and it was just a tremendous experience, and I'm very thankful for the opportunity to work at those places.
Yeah, I mean, those are great learning grounds. And if you're trying to think multi-factor, multi-duration, like there's a I think some people would say that there's like some kind of like vanilla over here at SAC, it's super short term, and Adage is longer term, that's chocolate. That's not the case. Can you talk about like just watching, like just different durations in terms of how people think about risk in different environments, but still very successful, hedge fund environments?
No, you're exactly right. And I mean, there's no single way to make money. There's no single way to manage risk. I will say there are better ways than some. And what I was fortunate enough to see is how world-class guys were able to do it. And the one thing that became very clear to me, especially watching the guys at SEC and Adage, I always viewed the world as really good, deep, fundamental work, that it's table stakes in the world. Being able to quantify ideas, come up with theses, test them, talk to management teams, really come up with ways to dimensionalize and understand what you're investing in. And on the other side of the world, you had traders. You had really guys that understood the microstructure of the market. They understood options. They understood the flows of the market. And there were a couple guys that I saw interact with. They were really world-class at both. Could they be a world-class investor, understanding the data, come up with big themes, and at the same time be world-class traders? I think there's this binary conversation that happens that you either have to be a great fundamental investor or you have to be a great trader. I view it as, why can't you be both?
Yep.
Why can't you really try to immerse yourself as a student and do both in a world-class way?
Mm-hmm. And now, and we'll get into it, your views on man versus the machine, or man and the machine is probably a better way to put it, is that you can do both. You can do multiple. You can replicate multiple using technology. This is going to be like a really cool part of this discussion, but I want to make sure that we still tack on your timeline. When you have, like, let's just say you got, hedge fund manager A, B, or C. Like, they, what do they look like compared to the best baseball players you ever played? Like, just pick A, B, or C. I mean, the top three, however you want to describe it. Is it mentality-wise, behavioral, training, et cetera?
It's just like a great question, something that I think about all the time. I was fortunate enough, my father played in the NFL for the Redskins and the Bills and the Chiefs, and I was blessed to see how real professionals approached their craft. Joe Gibbs used to tell a famous story about Charlie Joyner. Now, Charlie Joyner was a longtime Redskin, special teams, real culture guy, just everyone loved him. Famous story about Charlie Joyner was if there was a 8 o'clock meeting, Charlie showed up at 7:30. He already had his workout in, he already watched film, he had 3 pencils sharpened. He was famous for rookies asking him to borrow a pencil and he'd yell at them. So my dad always told me, you gotta be a professional. And how you're a professional is you approach it in a very serious, relentless way, and you immerse yourself in your team and everyone around you to really, really bring out the best in what you can do. And as I think about some of the legendary guys, whether it's seeing Steve trade, whether it's seeing Gabe Plotkin in the consumer space, Harry Schweifel, another legend, is running .72 right now, Dimitri at Balyasny, the Adage founders, Bob and Phil are, I think, 2 of the most legendary, with some of the best humans and best investors that most people have not heard of. They all have very similar, I would say, traits. Very, very deep industry and company knowledge. First and foremost, lifelong learners. 2, just relentless in how they pursue their business and their craft. 3, that they always get through tough periods. Like, one thing I always tried to, whether it's in my life challenges I faced or seeing them face different obstacles, just relentless in how they approach getting through different trials. And then lastly, just unbelievable, just business builders. Like, a lot of people, we spend a lot of time, Keith, you have a business, I have a business, you think about whether it's stocks moving on a 1-minute basis, but really what we're trying to do is be stewards, being stewards of our families, being stewards of our business, being just really good stewards with other people's capital and other people's time and other people's lives. That's what I think is the biggest thing, which I took away from the founders at Adage, is that building a business is more than just P&L. It's being a good steward for business and the people that you work for.
Yeah, there's a lot of names. Harry Schweifel, former partner of mine, to a T. Like this, these are the types of people that you want to surround yourself with and play alongside and learn from.
Exactly.
I often find, it's one of the great blessings, we have many, like in our community, is having all different types of money managers. They don't have to just be hedge funds. But I found it fascinating in the first 5 years to see how other people ran a hedge fund, right?
That's right.
I came from the Dawson Sandberg Pequot type environment, Captain Stockpicker, to the Magnetar environment. Whoa, what a collision, right?
That's right.
And now that collision, we've already had that collision, and we have a whole other thing that we're about to get on the right side of, which I think you're way ahead of. Wow. So let's get into that. Two types of meetings. So if I take, and my clients won't care if I say this because I say it to them. Yeah. I'm like, what world are you living in right now or is this the one that you want to be in, the one that I used to be in for 10 years?
Right.
Because that's not the one I'm talking about.
That's right.
Some people are like, tell me more. Some people are okay learning something from somebody else. Some people it's just like, I've made my dough, whatever. Those are the two kinds. We either have the learners who have evolved and who are actually crushing it right now in many cases, or we have one by one, there'll be a canceled institutional subscriber. They might become a family office. That's how you start a family office, because they can't punch out returns. Yep. And they're still fighting it, man. It's not an inconsequential amount of people. I mean, it's a lot of people.
Well, if you think about, change is hard. Human beings are very linear thinkers. We don't do exponential at all. We're not good at acceleration. We're not good at non-linear type events. And if you think about my first 10 years in the investing space, let's take it 2010 to 2020. It's a very interesting regime that happened in the market. It was dominated by post-financial crisis. It was a decade dominated by really the rise of the Mag 7. You had software as a service, which was just emerging. You had this transition from on-prem to the cloud. You had even low-vol kind of dominators, which really dominated that era of 2020. And kind of the context for me was, at Adage, I was going out to Silicon Valley, spending a lot of time meeting with cutting-edge companies. And I started hearing about machine learning and artificial intelligence really in 2017, 2018, and me being an engineer, I dove right into it. So I saw that the world was not only making this major shift from on-prem to cloud, but really this idea of human intelligence being augmented with machine intelligence. And it's funny, really what crystallized it for me was, and you'd appreciate this, I was just getting back from meeting all these private companies, probably in 2017, and I was reading, it might have been 2018, later in there, I was reading Nick Saban's book, Fourth and Goal Every Day. If you've read it,
Great book.
I'd really recommend it. There's a small section in there where it talked about how, as a coaching staff, they were on the forefront of technology. They were actually logging all of their players that they were recruiting, their attributes. They were looking at hand size and foot and speed by position. So they were breaking it down to what are the attributes of the best players? He could have gone to recruit an All-American linebacker. If it did not meet the height and weight requirements, he knew probabilistic-wise that guy could be very successful, but the probability of fitting in his system and being successful is low. So it really made me think about how the world was shifting from this idea of compute on-prem to the cloud, machine intelligence. Why couldn't you apply very similar tooling to the stock picking world? Well, and that was really the genesis of Issachar.
But it's not like this stuff is rocket science. I don't mean to what you've created actually would be some version of rocket science. You actually need man and the machine to be able to take off in the machine. It's not unlike a high-end Ferrari or whatever else. I mean, you want the best fighter jet you can ever find. You need a pilot.
That's right.
But the basics, man, like a weighted sum, or a weighted average.
Totally.
Factors.
Totally.
These aren't things that, it's just that the finance industry took so bloody long to get to where the rest of the world, intuitively Nick Saban thought about it that way.
Totally.
He doesn't have to be a quant.
Yeah, that's exactly right. And
right.
It's interesting, I get these questions a lot about where Gen AI fits in the finance world, and at least how we utilize it and kind of the framework I utilize it is, it's kind of these big buckets of learning, building, predicting, and then reacting. So what that means as far as Gen AI is, if you think about in the learning space, I'm a big believer that companies of the future are going to be exponentially smaller than the companies today. Because you have this unbelievable productivity that's coming as people start to understand these tools. So from a learning standpoint, I could go in and read a math paper by, I love reading the Cornell white papers, whether it's a new process in machine learning. A paper like that would have taken me a week to read before. Now I can read that in 30 minutes and recreate code in that in probably an hour. It's unbelievable from a learning standpoint. So
cool.
It's totally an acceleration learning. From a building standpoint, we use it every day in our coding. Like I have one of my head of engineering, really smart, talented young guy. He's a 10x engineer. With these co-pilots, he's like a 50x engineer, and he's the power of 7 to 10 of these different, really these tools that are out there. So learning, building, and then on the prediction side, we use a lot of machine learning to help us understand what's going on in the market. And then on the reaction side, I think one of the most interesting aspects for especially AI and Gen AI is this idea of early warning systems. So we've built these risk models, and I think about AI as a data synthesizer to help you make better decisions, to help me make better decisions. Can it take all this disparate data and really help us to inform context what's going on, synthesizing so the human as the last mile can say, I agree or I don't, or I disagree. What you're talking about is people not even understanding, is this going on, let alone make a decision.
Well, it is going on. It's just I'm not willing to change what I'm doing, change my life. I'm just not willing to change is the answer.
Totally.
Right? Which is
well,
not the way that we actually want to compete with that is what I keep saying.
And you think of change, I mean, there's a tremendous amount of structural change going on in the market right now, whether it's the mutual funds and ETF battles that are going on, the rise of the retail trader, which I actually have a lot of respect for. A lot of people talk down about retail all the time. They've outperformed a lot of investors, and I have nothing but respect for what retail has done the last 5 years. And you think about the technology changes that are happening. Like there are big structural shifts that are happening, and as investors, we have to recognize those.
Let's get into that with some pictures momentarily. But
Sure.
Can you just define when you say man in the machine? Like if you don't get that, you don't get what we're talking about. Can you
That's right.
start with that?
So. The genesis of man and machine was really this idea of kind of give you, let's contextualize it with kind of what's going on with the AI kind of CapEx build right now. Everything you hear about, whether it's on CNBC or in the media right now, in reports, it's all about the AI spend that's going on. So like what's really going on? AI CapEx spend is an output of what's going on right now. The inputs to those are all these companies need more flops. Now, what's flops? Flops are basically horsepower for math, right? So they need more flops. How you get more flops is you need more GPUs. How do you get more GPUs? You need to build more data centers. We need more energy. Now, all of this is meant to give more tools on the training and inference side. And as I think about it, to make it real simple for people, it's when GPT-1 came out, I think the numbers off the top of my head was they trained the first model on 117 billion parameters, and I think it was 117 billion parameters, 1.3 billion tokens. So the math of that is 6 times 117 billion times 1.3 billion is 9 to 10 to the 17th. Now, Grok, which is one of the latest machines right now, they've talked about 340 billion parameters in MOE type process. So let's think about this. You have, that'll be about 75 billion parameters times 6 times, it's estimated 2 trillion tokens that has trained Grok. So that's 9 times 10 to the 23rd. Now, that doesn't mean much, but I'll put it really simply. It's basically like saying if GPT-1 was trained on, it took 1 minute to train, it took Grok 22 years to train. If GPT-1 took $1 to train, Grok 4 estimated 650 million. So these are these machines that are being created, and as I think about this move that's going on, I think about it as all this money is being spent to build these tooling, whether it's large language models, whether it's agents, I view it as an augment to deep industry expertise. And that's really where I think the future is going. It's people with really deep industry expertise having an agent that's, I call them vertical agents, custom built really to help you make your job better. And when we talk about man and machine, it's really this idea of, can I use tooling, large language models, agents trained on factors, agents trained on option data to continually service up information to me as the human to then hopefully make better decisions from a stock prediction standpoint, from a subsector, from a risk management standpoint. So the machine is really this amalgamation of investment made to help you make better decisions.
Well, factors you have to, like Captain Stockpicker's dead, factors are alive and well, the number one thing that I need to pay attention to every day, and so does every major hedge fund that actually is delivering. But the majors you mentioned, for those of you that don't know, like there's Citadel, Balyasny, Millennium, these are the big, what they call pod shops, that all essentially, they don't run on the exact same thing, but they run on the same principles of risk management. Like you can't have a drawdown, you can't have this happen to this factor, that happen to that factor. This is actually how I learned how to build mine. I was like, Harry Schwefel and I were at Magnetar, and I was like, instead of getting the, hey, reduce your small cap factor exposure by $37 million by lunchtime, I was like, I want to build a model to front run that.
Yeah.
Because there's got to be a decision that gets them to call me.
That's right.
A decision making tree. Right. And they're factors. Right. And they're general. So I started with 1 month price momentum. Yep. And it's like, is that really what they're going with? Yep. But if you just go backwards from how the current systems are created, you can start to create a system that replaces it.
That's exactly right.
You think that's exactly right?
I
haven't spent the amount of time like you had with Issachar, and maybe spend some time on that. First of all, tell people what Issachar is, the word.
Issachar is one of the tribes of Judah, and it talks about in the Bible how the men of Issachar, they understood the times and they knew what to do. So my family, we have a family foundation called the Issachar Foundation. We focus a lot, 100% of our time and energy is focused on single mothers, children, and Christian education. And I always thought about, what a powerful way to be a steward of capital and other people's time and money than to have a fund, and Issachar Technologies was a natural evolution for us.
That's awesome. So, yeah, it's not like a Greek god or some mountain.
That's right. It's not Kubin capital, or it's not whatever Greek capital.
And you are Viking by descent.
That's right.
So you could have called it like a lot of things.
I thought about some cool Viking words for it, but we land on Issachar.
But take it from me on that. I just at a very superficial level, but with intense knowledge of how that works and what I've built to front run it. My view of front running the machine. Yeah. Walk people through how you think, the future state's going to look like building it your way.
Yeah, so I've been doing this series on Twitter. It's called Liquidation Nation. I kind of just came up with that. I was dropping my son off at school, and I was thinking about there's been some amazing factor bombs that have gone off this year. And really in the last 6 weeks that have really shaken up, I think, the long-short space. And I think the drivers of that is post-2020, and I'll really say post-COVID, the world has changed. Now the world has changed from I would say, asset world of you have the mutual funds and the ETFs fighting for market share. The hedge funds are in this churn where, the pods, a lot of people have talked about the assets that they've gathered, all of the gross exposure there, 0-day options. So there have been a lot of drivers that have changed, I would think, over the last 5 years, and to where we started this conversation earlier of people refusing to change. The last 5 years have shown you, you have to change, or the market is going to drag you and force you to change yourself. So how do we be more proactive in how we think about the world? And that's really what I think your question is asking. It's we're in this decade of Mag 7 and software, COVID happened, structural shifts went on in the market with liquidity, the rise in retail, the rise of the meme names, the rise of options, and it has really created this regime shift. And if you were an investor that invested pre-COVID, where your process was thinking about starting with valuation, or starting with a comps table. You've probably had a lot of trouble in this market, and your process has been forced to adapt. And where I think the world is going is, I think the world is moving towards this idea of man and machine, of using machines to build models that help explain the world and help you predict the world. And there's going to be times where the human is going to have to overrule the machine. You've seen it the last 6 weeks, where high vol, since the lows in the, let's call it the tariff fiasco, high vol's up 180%. Think about that in the context of the Qs or the S&P. It's up almost 4x what that's up. Meme mania over the last, I would say 4.5 years is up 800%. So you have these unbelievable factor movements that you've never seen prior to COVID. Mm-hmm. So as a fund manager and as someone that is a student of the market, you have to, one, can you identify these? So can you create a system that helps you identify what's going on? The root of everything we do, and I think about the world, is can you really dispassionately, not how you want the world to be, but can you identify what's actually going on in the world? 2, can you have a system that allows you to either capture it or not fight it and not lose money while these regimes are going on? And that's a decision that every investor needs to make for themselves. So for us, it's identifying and building these models that help explain the world. And then looking forward, it's can we use this framework to then help us build portfolios that we think will do well in all types of environments, not just the last war, but the next war that we're going in. I think about all the time that I get a lot of complaints on Twitter about how the market's wrong or there are bubbles, or I mean, I'll just say the market's never wrong. It's the market's never wrong. People that make money are never wrong, whether it's the person that invested in a quantum name a year ago and had made more than investing in Apple the last 17 years, that's real money. Yeah. Now, the question is, though, I would say, is okay, that's the past. What is your view of the next 6, 12, 18 months? Because that's where all the focus needs to be, not on
well, you have to have a DNA like Jared. You have to have a DNA like mine. We don't start with that intellectual hubris that I called out of a certain clientele that's going away. I don't start with, I had a 4.0 at Harvard, I had a 1600 SAT, I'm smarter than the market, this is wrong, this is a bubble. That's how a lot of people think because they were paid to do it. Oh, I'm going to be like Warren Buffett. No, you're not. Warren Buffett's retiring. No. So again, right. But if you start with I don't know, and the machine knows, and now we have tools for that to figure it out, why would people believe in Bitcoin and the entire calculation just having to get faster over a period of time, but not believe that the entire market isn't working the same way under the same machine parameters?
That's right.
Right? It's not about how smart you are. It's about how humble you are.
That's exactly right. And I think someone asked me the other day, and I think extreme humility is one of the things that I think about for myself, and I think about with other people. The market is a very humbling machine, ocean, whatever you want to call it. And every day, it's what inspires me every day, because with that extreme humility, it inspires me to get up and understand the market at a deeper level, create new systems, create new risk models, and hopefully look at it in a slightly different way that adds value to my family and my clients and LPs, and gives me the opportunity to have great conversations like this.
Well, what's great about it is that you and I have a bias. And people that think that we're crazy will say, well, they have a religious bias. They think you need to have the humble observance of the wisdom of God and of the machine at the same time. Those two guys, I bet you that they would agree on that. Yeah, I agree with that. Well, but I'm like an atheist intellect. Okay, that's great. You're smarter than the market and you're an atheist. That means you have a bias. Yep. But I actually do think that it's a good starting point for humility.
Absolutely. And as I think about my life and I think about different challenges I faced and trials, and really the lifelong quest I've always been on is just being a lifelong learner. And AI has totally accelerated my learning in many ways, and I think it's going to accelerate everyone's learning, which is an unbelievable aspect of what's going on in the world right now. But I think you're exactly right. It's something I strive for every day, and And if you don't have it as an investor, the market will teach it to you.
Yeah. The amount of things that are appearing to me. I had a new prospective client meeting, and he's like, why do you think you're more accurate these days? Can we talk about like when you're wrong? And I had to go back for me, like, because I screw up a lot. I had to go back actually as far as I have been able to before, like my last royal fuck up. And he's like, well, so what if that happens again to the quads or the signal in the quads, and how do you react? And it's always like trying to prove why what he does. The new clients are usually trying to prove why they do the way they do it is right, and what you came up with may or may not be right. You must have been lucky for the last year and a half. And it's like, maybe I have been. But what ends up, it's like hard work, right? It's like the more you put into it, the more luck you have. The more AI impacts markets, market structure, the flows, the more success I have. Because my entire process is based on its principles.
That's right.
You cannot say you love AI and you're going to spend the world's most gargantuan CapEx nut on it and not understand fractal math.
That's exactly right.
Right? The human mind can't understand fractal patterns. That's why we have them. They're not round numbers.
That's right. That's right.
So how do you, like, on something like that, do you need to get caught up in the, fractal dimensions or anything that I talk about, or are you more focused on your interpretation of market structure, and you might take other people's tools to augment it?
I'll tell you one of the things that I really struggled with kind of in my career as an analyst. My coverage grew kind of as I progressed in my career, whether it was just covering the first 20 SaaS names to then where I finished up. I think my universe was up over 125, 150 names. Now, one of the things I really struggled with is out of those 150 names, it's very hard for an individual analyst or PM to know the ins and outs of those daily, whether it's the news flows, the model updates, the meetings. And I found myself kind of that 150 names really kind of focusing on the 20 or 30 that were the most relevant at the time.
Yep.
Now, the stock market is way bigger than 20 or 30 names, and here I am just really hyper-focused on the 20 or 30 where I should have been zooming out to the bigger picture, whether it's sectors, themes, factors, different names outside of my universe, different asset classes. And where I think AI is going to be really impactful is it's going to expand that coverage universe, and it's really going to be like, okay, if my coverage is 150 names, it'll be serving up to me. So one thing we spend a lot of time doing is understanding sentiment in Twitter. And my early warning system is serving up to me all the time synthesis of, hey, the meme names, here are the top 10 meme names that they're talking about on Twitter. Do we have any positions in these? And it'll jog my memory, like maybe because I'm focused on the AI CapEx that I posted last night in my chart, but in reality, I have a risk in my portfolio that I wasn't even thinking of that the early warning system served up to me. And now I'm back focused on, all right, put the AI CapEx down, let's think about risk because it was served up to me. Do I have anything I need to do in this today? So as I think about it, it's going to really broaden out and really surface up what I think is relevant information at the time that's needed.
Yeah, that signaling system works both ways. I mean, like, I didn't know shit about the Russian pending incursion in the Ukraine, but I had my RSX signal, which was at the time the only ETF that was liquid for Russian stocks, which has since been delisted. Right. It was such a good short.
That's right.
But I had that similar set versus WTI trading versus Brent, et cetera. And it's like, then I look at my quad model, it's like, okay, over here, that's quad 4 in Russia. That's when countries typically start shit. And I didn't have to know to position for it.
There you go.
I don't think a former self would be hired.
Yeah.
Like, I got hired at Carlyle because I had a good track record that I could show them. And they're like, and he went to Yale. Maybe that's what they thought. That would be in their DNA.
And good hockey player.
But that's how they would think about it. Like, the whole notion of he's smart has to be attached at some point. If you're at least marching on a decade into this, you have to have performance.
Totally.
You can't just be smart. But if you have both, and you had both those things from who I was 15 years ago or 20, I wouldn't use them. Like, I would fade them. I would fade my former self.
Yeah.
Right? It's just like totally. Harry Schwefel could build, and I could, like, he could. I'd just listen to him. But he could build. If you told him to build a model on X company X, There are very few people in the world that could build a better model than him when I worked with him. And like today, I would make a lot more money without having a model on the company by obeying the flows, the structure, the signal. Like it could make you a little unnerved about the whole situation.
Yeah, well, I think this industry, what's amazing about the investing industry and why I get up so inspired about it every day is it's ever changing. And you either embrace the change or you don't, as we've talked about. And in your career, you're either embracing the changes that you're seeing in the market, and you need to update your process at the same time. A lot of people I hear are very religious and dogmatic about your process, and I think it's really a lot about life or faith in the same way. It's this dichotomy, the dichotomy of leadership that Jocko talks about, or the dichotomy of investing, where you need to have this process that is deeply, I would say, researched, deeply ingrained in who you are. But at the same time, you have to be flexible to change that process on any given day with new information. And I think that's a very hard thing to do, whether it's a father wanting the best thing for your children, being a very tough disciplinarian, or at the same time giving them the most love and shepherding them through life at the same time. It's this dichotomy that I find fascinating, that I explore all the time, and exactly to what you're talking about.
Well, you can have certainty around certain things. Family's a good example, but then it's the uncertainty that grabs you, right? I mean, It's the destabilization. If you guys go to the first slide that Jared has on structural shifts, big opportunities, I mean, these are massive tectonic plates, right? We as human beings know what those are.
That's right.
That's what we know. Not everybody starts with, hey, let's just remember what we know. That's a major problem for them. It's not, I always say, let them. That's how the way they want to start. But we actually don't know what's going to be destabilized at a fast, like when you say exponential or at a faster pace, what's going to fortify faster, what's going to destabilize faster. Can you talk about that within those four big tectonic plates? Because those are the big ones that really move the market.
Well, as I think about these big structural shifts that have happened, really, leading up 2010 to 2020, post-COVID, you look at the top two, some legendary investors in the mutual fund space who I have nothing but the utmost respect for. It's interesting how the rise in ETFs, where I think the latest stat I saw was the average cost in ETF is around 10 to 12 basis points, and the average cost in a mutual fund is around 40 basis points. So you have this huge pricing gap between the two, where you have now daily liquidity, levered liquidity, and thematic liquidity offered in the ETF space. So naturally, there is this unbelievable battle going on for about $35 trillion of capital right now. I mean, it's really amazing to think about it.
Yeah.
And then obviously the hedge funds are going to do what they do, and there's really this interesting dynamic happening in the quant space right now, where I think we're in the midst of a very big quant revolution that's happening. It's the two major things are you have market makers becoming mid-frequency players, which has a big impact on the market. And then you have this rise of what I think is this man and machine it was the first time I heard Man Group talk about how they overrule their models sometimes. Renaissance was famous they said they never overrule their models. Now, they were right most of the time, and they probably shouldn't overrule their models. But in this new world of data doubling every 2 years, factor bombs like we're seeing, this rise of zero-day, these regime shifts that we're seeing, my view over the next 10 years is that this complement of man and machine is going to be where active management moves.
Yes.
And that is where, whether it's a PM and an agent, whether it's a fund and their own custom-built LLM, whether it's a human with a LLM risk model where they're talking to it instead of it being a traffic cop like we were talking about earlier, hey, you're outside of momentum, get back into it or we're cutting your capital. These interactive systems, I think, are going to help people make better decisions instead of the past of, hey, here's a problem, fix it on your own.
Yeah, look where early movers are moving within those four tectonic shifts. You have two of us sitting right here. The number one reason why the top layer doesn't move is they're getting paid.
That's it.
If you're running a mutual fund and just getting paid and you're 70 years old, you're not going to turn into you or I in most cases. That said, most people in Hedgeye Nation that are retired, that used to run these places, agree with our process more than anybody that I know. They're like, it's an incredible thing. But passive, no risk management.
No.
Every ETF that I'm launching has risk management. Let's just start with that.
Yeah, exactly right.
Hedge funds underperforming because they're supposed to have risk management, but what they're doing doesn't work.
Yeah.
And then of course the quants are becoming your new, like quantamentals becoming the best hedge funds are the ones that have some quantamental principle at the core of what they do. So it's interesting, like you're going to basically, it's just like the classic take share from the top of the mountain, and at the bottom everybody's just sitting there. You and I are sitting right there.
I think what's going to be interesting in this is if, God willing, we're sitting here in 5 or 10 years still talking about what happened. I think that pyramid is going to look very different than what it looks like today.
I think it's going to, first of all, it's going to like invert.
Yeah.
but it's going to invert fractally. There's another good chart that I like that you have because you use Tier 1 Alpha. If you go to the fourth chart, guys, in the deck, and just talk about this, because I don't think enough people, first of all, they'll be like, oh, that's, the answer always from a really smart person that doesn't really want to incorporate it in their process will be, oh, that's really interesting. As opposed to like, what do I do with this? Like, how do you make decisions with the daily structure that is the U.S. equity options market? How do you plug that into your process? Like, that's what people are asking me that know what they're doing or want to change.
You know, I love this chart, and that's why I knew you would appreciate it. Like, I look at it and I just think, wow, like the market has just changed so much, even since zero-day options have come out. If you take a step back and think about it, right? This idea of liquidation nation, or this idea of, I talk about it on Twitter a lot about how the world has really moved from in the last 5 years from like modern portfolio theory to where I kind of kid and say modern portfolio theory is dead. Of Harry Markowitz he would roll around his grave of taking risk-adjusted returns and you should be compensated for more risk. No, the mindset now is, I posted this video where this crypto investor was talking about how 10% or 20% of your portfolio should be in these high leverage perp contracts that you're either making 50x your money or you're going to zero. Like, that is liquidation nation of these tails are now really, really taking on huge amounts of risk.
Yeah.
And the 0 day is just another expression of this. And it's just another expression of very short-term dynamic battles going on between market makers and, I would say, shorter term, really liquidation nation investors.
And it's not just some cray-cray guy in his basement.
No.
It's the center book at major places in Chicago, Boston. They understand that fading their own guys is a great business.
That's exactly right.
Right? Because if you got a bunch of captain stock pickers and they all have the same short position,
that's exactly right.
Why don't we reverse it and put the right pressure on them that we know in our own rules they have to reverse the position?
No, I mean, the center books are very complicated and very, I would say, complex right now, and very good at managing risk, managing exposures, using 0 day to magnify or even dull certain exposures that their portfolios could have. I mean, that one you showed, which I found fascinating of it, is how, I don't know what the latest click is. You probably know more than I do, but 75% of the S&P is now option of 0 day right now.
Yeah, it's crazy.
60 to 70% of that is retail or investors. So there's this, I would say the so what of that for everyone is there is this non-fundamental price insensitive action that goes on in the market. When people scratch their head about what's going on, it's really understanding that component of it where, it's not aligning with my comp sheet, Keith, like my 100 times sales names or infinite EV to sales names are moving 10% a day. They shouldn't be doing that. Well, there's these dynamics of the ETFs, celebrity ETFs, the 0 day going on that you have to understand about what's going on in the market.
Yeah, it's called human behavior.
Yeah, that's
not in your comp sheet. That's not in your valuation model.
That's right.
And it's unfortunately we have to wrap up. I could go on. We will go on and on. And I have a good feeling about that. But look, who would have thought of all these, like, maybe I should next time, like, just put on a costume and be my former self. Like I never was an intellect, so it wouldn't work. But oh, that shouldn't happen.
Yeah.
It is happening.
Yeah.
And who would have thought that all this non-fundamental action would actually just perpetuate not only the inversion of that pyramid.
That's right.
Or the melting of their ice cubes.
That's right.
Just the arrogant assumption that everything has to fit in their old box, their old wall box.
Well, I think if the market ever teaches anything, is it's an unbelievable discounting mechanism. Whether there's bubbles going on now, or they are bubbles or aren't bubbles, the market's never wrong. It's our job to be intellectually hungry and curious and have humility, understand what's going on in the world, and just attack it with a relentlessness to hopefully provide the best product and shepherd and steward the best products that we can for our family and our teams and our companies. And yeah,
I love it, man. Because we'll wrap up here, but one of my greatest fears about like our profession is that this progress isn't happening because I can't see it.
Yeah.
But that's my own bias.
Yeah.
Like, I never met you before, but now if I meet 10 more guys like you, which I won't, but you just can have faith, again, that the light is stronger than the darkness, the hate is going to be quelled by the success. Right. And it's very American, actually. It's like very, it's like progress.
That's right. Yeah.
And what you're doing is really cool, man. So congrats.
I appreciate you having me on, Keith. I'm a huge fan, Hedgeye Nation. It's you guys are in great hands with Keith, man in the helm here. So I appreciate everything you're building, and it's been awesome.
Thank you. I appreciate it. We could go on and on,
but before we wrap, Keith, I did want to give you something.
Oh, really?
I brought you a present. So this is my thinker. This is for you. So it helps me think every day. It's a clicker. And
nice.
This is for you and your desk. So it's brought me a lot in my career, so you can click it back and forth in your hands.
Oh, cool.
So it'll help you think as you think through your quads and you think through kind of where the market's going next right here.
I'll think through the quads. Every day's leg day at Hedgeye. Right?
Hey, that's exactly right.
Thank you. We'll be right back. Thanks for joining us.